Yeah, hi. Hi,
Okay,
Michael. How are you doing?
I'm doing well.
Great. Yes. So first of all, welcome everyone. I'm the founder of Quidroom, the social platform for where accredited investors and investment professionals globally find each other. Before we kickstart, for all the investors who are listening into the session and the podcast, if any of your questions are unanswered or you just want to have a chat about investing, feel free to reach out to hundreds of investment experts globally by joining the communities now live in Quidroom. To attend future similar sessions, you can join hundreds of other investors in my personal Quidroom community. The community handle is posted in the comments here. Now, over to you, Michael. Great to have you on board today. How are
Thank
you
you. I
doing?
appreciate it. I appreciate the invite.
All right. So a bit about you, investment strategist, investment officer for almost 30 years for multiple firms. In between, also a portfolio manager for Thiel Macro, managing the personal capital of Peter Thiel. Recently, you joined the stellar team of Simplify, a firm that focuses on helping advisors tackle pressing portfolio challenges with a set of options-based strategies. So let's start with that for now. What actually convinced you, Michael, to join Paul and David for this journey?
Well, so the easiest answer to that is recognizing that the change in the regulatory framework that occurred in September of 2020 with the introduction of what's referred to as the derivative rule for ETFs, um, that allowed ETFs to incorporate strategies that were historically only available within hedge funds, um, it changed the game significantly. And it did that in two ways. One, it actually made it legal to create these strategies and to do so in a manner that did not require a lengthy comment period from the SEC. So it dramatically lowered the cost of launching these types of strategies, in many ways, making it on par with launching a traditional strategy, a traditional ETF. And in some ways, once you've started the process, it's easier than launching a accredited product. The second thing that I recognized when we did this is that it allowed us to introduce the tax efficiency of ETF structures to derivative strategies. And so many hedge funds specialize in investing or providing investment services to tax advantaged institutions for the very simple reason that you don't have to worry about the tax dynamics associated with options or complex structured products that often create unfavorable tax treatment. By embedding those strategies within an ETF, which is a tax efficient strategy, it actually became quite attractive. And so from my analysis, we're just going to continue to see growth of the active ETF space, building out around strategies that increasingly offer active components to them. And in a large part, I think a lot of those are going to incorporate derivative components where the tax advantage really works to the investors, advantage. The downside, of course, to it is that from a relative to a hedge fund, there's not the opportunity to make the extreme one-time gains. The flip side of that is, of course, the stability of the capital base that you build and your ability to build effectively an ongoing financial investment firm that I would argue has much better alignment ultimately than a hedge fund does with the investor profile.
Interesting. And that actually brings me to one of the questions that one of the investors asked, and I'm just going to just read it out. There's no doubt investing in passive equity ETFs indices has outperformed active funds as well as other asset classes over a long period of time. So is there an element of mixing passive with active and adjusting allocation based on some macro indicators to enhance even the returns and risk further? Kind of what some sophisticated robo advisors are doing these days. It would be great to hear
Yeah.
your views around it.
Well, so that actually feeds directly into a lot of the theories that I'm well known for and a lot of the work that I'm known for in terms of the dynamic of passive investment strategies and index investing in general. And to emphasize what we're doing at Simplify is we're taking those traditional beta exposures, the S&P 500, for example, or US equities, or even high yield profiles, and we're enhancing those with modifications that are created either by the use of things like a total return swap, for example, or through the use of derivatives that can modify that payout in one form or another. The reason why passive outperforms and the degree to which passive has outperformed, I think, is an area of very active discussion and debate. And so the traditional theory behind it is that passive strategies outperform because they're cheaper, right? They offer lower investment management fees. The degree to which they have outperformed investors, though, has been so active investors or discretionary investors has been so extraordinary that it forces you to ask a slightly different question, which is how could you possibly have built a system in which the active managers who theoretically are supposed to become more skilled over time are actually so terrible against a passive benchmark? And this was a key contributor to the work that I've done in terms of the dynamics of how passive investment strategies actually distort market returns. You can frame it if you think about it, a university setting, right? If 50% of the students fail a test, I would argue that's a function of the students. But if 95% of the students fail a test, that's a function of this instructor and the test design, right? Something went wrong there. And that's what we're seeing in the active versus passive dynamics is that there just is almost nobody on the active side who's capable of outperforming. And the question of why that's happening, to me, has been underexplored. It's very easy to say, hey, people today are not as good as George Soros at managing assets. And there may be some truth to that. But ultimately, I don't really believe that.
And you had mentioned in one of your previous sessions that you are more of a investigator than an investor. So
in a lot of ways, yes. So, I am not the guy you want to hire to dig into Apple's earnings report and tell you exactly what the discounted cash flow value of Apple is going to be. That actually was my role in a prior life. The role that I play today is much more around figuring out the dynamics of market structure, figuring out what are the actual answers to the sort of question I just posed to you. What's so wrong with this test that effectively all these incredibly talented, smart peers of mine are failing these tests, right? How can that possibly be happening? Understanding why that's occurring and developing strategies that take advantage of the insights that are derived from that can be quite powerful.
Absolutely. And Michael, what are the changes that you expect to happen in the next 10 years? I mean, your intuition around it, so that active can become more efficient.
So I think this is unfortunately part of the dynamic, which is the insights that I've offered to people are that as long as the framework exists to favor the growth of passive strategies, that what we're actually experiencing is a distortion of the return surface. Right now, we're not showing graphics. There's several videos out there on the internet, and we're very happy to speak with investors individually about these types of dynamics. But effectively what's happening is that the traditional market structure is being distorted by the growth of what I refer to as price-insensitive investors, right? So the difference between an active manager and a passive manager in general, if you think about the marginal allocation of capital, when something goes up in price or rises in valuation, all else being equal, a discretionary manager would treat that as suggesting that future returns will be lower, and therefore it should allocate less capital to it. Now, if you just mechanically think about how that plays out through a system, it means that when something goes up, it attracts less capital, therefore it slowly converges back with the rest of the market. When you introduce passive strategies, they operate quite differently. They allocate the next dollar of capital based on today's existing market capitalization, right? So they presume that the answer in the market is correct and that the increase in price has no negative impact on the future returns for that asset. And as a result, you end up with effectively a momentum reinforcing dynamic that causes the largest stocks to continue to outperform. It causes the stocks that have risen recently to continue to outperform, and ultimately changes the behavior of the market quite significantly as you transition from one type of investor to another. The scary part of my research is that this is an exponential curve, right? So what is happening today with passive share, by my estimates, somewhere in the 40+% range of US equity markets, that's far ahead of the rest of the markets around the world, is the more that grows, the more pronounced the effect becomes. And the less opportunities actually there are for active managers to outperform in an environment in which the efficient market hypothesis, where the behavior of securities is driven by information, versus what is the emerging theories that are starting to gain credence that largely are descriptive of my theories, what's referred to as the inelastic market hypothesis, where the flows behavior, the money flowing in and out of the market, has a disproportionate impact on the behavior of securities.
So I'm just going to move into a few of the questions that came in from the investors. So Adam in here is asking for some ETFs linked to, say, VIX oil leverage versions. We have some large structural issues, predictable rolls, negative gamma, in market leading to larger than expected negative performance. How would you view using ETFs for investments in these asset types, and also how to really filter out these structural issues prior to investing?
Well, so I actually think that's a fantastic question. For those who don't know, when I was managing Peter Thiel's capital, we had a very well-known trade around the XIV, and had understood that the volatility ETFs were a perfect example of systematic strategies. And I would just emphasize that passive has to basically mean systematic strategies that allocate on a certain basis, become so dominant in that space that it had set up conditions for an extraordinary event, right? On what was a relatively minor move in the S&P of down roughly 4%, that $2.5 billion XIV product went to zero effectively instantaneously. That's a model of what I expect to happen in the broader markets as passive strategies continue to gain share. But the questioner hits on exactly the right point, which is, when this happens in smaller markets, more concentrated markets, you can see the sort of extraordinary outcomes, like USO owning a disproportionate share of the May contract in WTI, that then has to be delivered into physical form with no storage available, right? So ends up having to go negative in price, right? Which feels completely absurd until you recognize that physical delivery of a toxic substance without storage, you probably have to pay somebody to take that off your hands. The quick answer is that when you look at these types of strategies and you see systematic strategies becoming so large relative to discretionary behavior that you can effectively predict what is going to happen to the market, that's a big warning sign. And you start to see the instability that arises around that. The real question is, how much of an influence are we seeing in the larger markets, right? So we've clearly seen it in VIX. We've clearly seen it in oil. I would argue we just saw dynamics around this sort of stuff in commodity markets in some way on a broader basis. The question is, where's the next shoe to drop in this? Is it in U.S. equities? Is it in much larger vehicles than traditionally have occurred? And does it have a much more systemic impact in terms of investor portfolios? The second thing that I would just highlight on that is that when you decide, the idea of responsible passive investing, right? So this ESG type framework, that's just another form of systematic investing, right? You're checking a box, and ultimately you have to understand that the minute you lay out that criteria, it's going to be manipulated just like college rankings in the United States, right? So if you figure out that you need X number of instructors per student to get yourself to go up in the rankings, then you'll figure out ways of making that number up, even if you hire unpaid instructors, right? So that's one of the things that I think is actually really important to consider. The second dynamic is, from a regulatory framework, we provide huge incentives and benefits to passive and systematic strategies. Among other things, we allow them to do things like present prior performance, even prior to the strategy having been deployed, right? So I could theoretically show an ESG variant of the S&P relative to the S&P 500 and show that it outperforms over time, right? Now, the problem is that history doesn't reflect my intervention as this new activist manager. And so to present that strategy under the framework that I would argue that we should all be operating under, which is the flows directed into the strategy actually influence the behavior of the market, the underlying market. And to assume anything else is just kind of insane when you stop and think about it, right? I don't think you should be allowed to do that. If I'm doing a strategy where I'm influencing the market, it's not really accurate for me to show that historical performance. And that sort of advantage is under-recognized and underappreciated by investors. And it's part of what's driving the flow into passive vehicles and systematic strategies that take advantage of this dynamic of the ability to post a historical index and say, hey, this is what you should expect from our performance. Because on a purely discretionary basis, I can't do that.
You mentioned about the shoe to drop. How important is it for investors in today's world to do something about managing their tail end risk?
Well, I think that's a really serious question, and unfortunately, I don't have a great answer for it. Right? The challenge is that we don't have a lot of tools available to us to help investors manage that sort of systemic risk of crowded strategies. It really requires an extraordinary amount of work to pull that data together, right? So, for example, if I use headline data or a lot of the data that you see publicly presented around the share of passive investing, and basically just aggregate Vanguard, BlackRock, and a bunch of other index mutual funds, I'd show that there's very low share of passive investing. But if I take that a step further and I turn around and I say, well, wait a second, there's a lot of separately managed accounts. There's a lot of commingled investment trusts. There's a lot of futures programs. There's a lot of insurance companies that are running structured products that reference index products without using mutual funds, for example, that are just managed internally. Total return swaps, for example, are another way of accessing a passive market, right? Expecting investors to be able to figure that out is really hard. And I'll be honest with you that I don't think the industry does a good job of publicizing it. And candidly, I would argue that the passive investment industry is working actively to conceal that information.
Interesting. So before we go into John's question, let's talk about currency right now, because the currency volatility has been really high, especially with all the macro events that has been happening right now. Euro just hit 5-year low. The dollar definitely plays a critical role here, right? Now, dollar historically has outperformed during times of risk aversion. How do you see things unfolding in the near term and the long-term impact that investors should consider about the current situation?
Well, so the currency dynamic, a lot of people are very familiar with the rise in volatility of the interest rate market, right? So it's referred to as the MOVE index, which actually was developed by one of my partners, Harley Bassman, that shows the implied volatility associated with hedging interest rates. Some people have tried to draw the comparison of that to the equity indices, for example, the VIX. That's actually not a great comparison, right? Because rates and equities don't have the same relationship that, say, rates and currency do. And so what you've seen is with the rise of interest rate volatility and uncertainty around central bank policies, you're seeing a concomitant rise in the FX volatility. Right. So it becomes a question of how can central banks around the world harmonize or normalize their responses to interest rates? And more importantly, how can investors hedge out the FX exposure so they can engage in things like covered interest rate parity, which is used for arbitraging the interest rate differentials around the world, right? As that volatility rises in the interest rate space and in the FX space together because of this arbitrage relationship, it becomes harder and harder to engage in that type of arbitrage activity. It creates a feedback loop and ultimately a deleveraging within the system. It feels like that is very much underway right now.
Interesting. So that brings me to because we need to let's try to understand a bit more about the long-term impact that US dollar would face in here. So Bank of America also just recently confirmed that US will likely move ahead with digital US dollar. And there has definitely been a lot of talks. MIT is working on this, and with issuance occurring between 2025 and 2030 is exactly what is predicted. Anyways, a lot of financial institutions, banks, the payment companies, Citi, MasterCard, all of them are concerned about the repercussions that this would have to their business. And that would definitely mean we need to understand the impact that it will have to the existing financial infrastructure that is already there, the financial companies, the public markets, when it comes to the financial service industry. What is the impact going to be there? But in addition to that, of course, this is a very big topic, right? Because CBDCs are now being issued by multiple governments. So, of course, China is already piloting their digital yuan, which has already been released in major cities, and of course, they have a goal of wider distribution by the end of 2022. And then you have the push by public for cryptocurrency adoption that is also going on. With all of these things happening, what is the impact of in the future for US dollar? One, and the second, impact in public markets for financial institutions.
So I think that there's and answer all that in 3 minutes, right? Okay, so first of all, on the dynamics of CBDCs and the general move towards digital securities or digital assets, one, I think that is an inevitable development. So it's somewhat ironic that we're sitting here, a fifth of the way through the 21st century. Computers have broadly been available for give or take 40 years. And if I were to, I usually keep it on my desk. I don't see a copy of it here, but I like to pull out an example of a 1 penny check that I received because my mother, thinking it would be a fun thing to do, bought individual stock certificates for my children in companies that they like, where they like their products. Those are framed on their walls. But unfortunately, that now makes me the actual shareholder of record. And so when dividend checks come in, I'll receive 1 penny dividend checks, right? Now, the average cost to write a check for a corporation is somewhere in the neighborhood of 50 cents, right? So I could get 50 times more money if they were if they would just pay me to go away, right? Or to avoid the actual cost of sending me that dividend check. And that's then exacerbated by the fact that I've got 1 penny checks that I've got to go through the process of depositing. Everybody's a loser in that situation, right?
Yeah.
The move to digital assets and digitally native securities, tokens, et cetera, solves that problem. It means I don't actually have to receive a paper check. I can have it immediately credited to my account of record, even though my security is not held at the street. Right. So that becomes fairly straightforward. And in my opinion, we're inevitably moving in that direction. It's going to be a combination of digitally native securities and tokens. We'll move away from the paper DTCC and QSIP numbers and towards a much more complex relationship. And that also then opens up the tools of finance in an extraordinary way to do things like, as crazy as it sounds, you could individually do your own structured product, right? Structured products traditionally are things like RMBS, where you need to compile thousands of mortgages and literally millions of pages of documents for documentation. That's why they're the province of banks, for example, as compared to individuals being able to create these products. I'm very excited for the world that we're moving to, where we finally break with our analog paper past and move towards those digital securities. At the same time, we need to build that infrastructure without any of those securities available, right? So we've got these nonsense tokens and product that is, ape pictures and stuff that is basically being pumped through these nascent pipes to try to defray the cost of developing this technology. Functionally identical to the dot-com dynamics, and a lot of the same nonsense is being spouted, right? So if we go back and we think about the build out of the internet and the ISPs, which are some of the worst areas in terms of losses associated with the internet, the irony, of course, is that it was all true. We use broadband, we use, all that stuff to an extraordinary degree, but all the companies died, right? And they were rebuilt out of effectively the dust. CBDCs play a really interesting role. They are effectively the replacement for the analog dollar bill that you receive with a digital security, right? Now, again, in the same way that I highlighted the dynamic of the ability to do a structured product on an individual basis, that then opens up the risk to the financial institutions that the traditional relationship that they have as effectively franchisees of the central bank, who go out and run the local McDonald's that I buy my food from, even as the national McDonald's sets the menu, describes the behavior, carries the corporate insurance, does all the reporting, et cetera, right? That's a banking system. This is effectively McDonald's and its franchisees. The risk is that the move, just as we saw in many franchise relationships, with a change in technology, it becomes easier for the main entity to actually get a direct relationship with customers, and that there's advantages associated with that, disintermediating the banks and that franchise system that we've relied on. That has both risks and benefits, right? And it's hard to know how that's going to play out. When we talk about a country like China, the model of a CBDC is one that inevitably is trying to capture all the control features that the CCP desperately wants, right? We want to know exactly what our citizens are doing. Now, the irony, of course, is that that is incredibly caustic and destructive to an economy, because spending behavior, what I do with my money, particularly if I'm doing it at small scale, that's sending the single most important signals to the market, to a free market that can possibly be sent, right? What are my actual spending intentions? What do I want to do? And if I want to use that, and I'm going to, speak in unfortunate terms because there's really no alternative, but if I want to buy drugs, or if I want to buy pornography, or I want to do things that are socially unacceptable with a fraction of my money, that's actually a very important signal that is being sent to the market, right? And the market will try to accommodate that. When you turn it into a surveillance system where the government effectively controls your credit, controls your ability to spend the money, and if it sees what it deems inappropriate behavior, you're going to pervert all those signals. That's why the China model is set up for failure. And ultimately, we in the West have to avoid the siren song of those control features and take advantage of what we're really trying to do, which is maximize the benefit that we're all realizing from it. So my hope is that the West adopts a very different model than what we're seeing in China. That's a harder model, by the way, to adopt.
I agree with that. And but then there's also the other side of the coin, where we have to think about a digital currency that is very easy for transactions to be handled, who's going to be releasing that first, and how friendly it is going to be for an international community to use it for transactions. And the political clout that a government would have in allowing multiple countries to use it, which would mean it may devalue US dollar if US dollar is not going to become a digital currency by then. So this is just me, just me putting a point in there, but do you think there is a risk that this would lead to devaluing US dollar if USD does not win the fight of become digital currency first in a faster pace than other governments do?
So the obvious answer to that is yes, right? If there is competing technology that is able to offer an improvement in services to individuals in various places around the world, outside the United States or even inside the United States, you're likely to see a push to adopt that in the same way that you saw Uber disintermediate the yellow cab business, right? When a competing solution emerges, if there's not a good response, clearly that represents a threat to the incumbent. I'm a little less concerned than most, because when you think about who are the potential rivals or who is introducing this technology, as you pointed out, China is pretty far along this path. There's ideas behind cryptocurrencies like Bitcoin or Ethereum, competing over things like the Lightning or Strike networks, using stable coins that are either deriving their value algorithmically or through trusted reserve levels, things like Tether. I think people are trying to move really fast into this space right now and trying to make a lot of predictions around it. Inevitably, these things tend to behave and develop a little bit more slowly than people think. So it's a little bit like the Hemingway quote about bankruptcy, right? How did you go bankrupt? Slowly and then all at once. I think that's what we're going to see with things like CBDC and the redesign of the system of pipes to be truly digital. We're going to see a lot of experimentation, a lot of playing around, and then all at once we'll discover that we're operating in a truly digital framework. It's important to me to frame things like the privacy, the importance of privacy, et cetera, because the solutions that are emerging, by and large, dispense with privacy in favor of surveillance. And so it's very easy to get excited about that marginal technology and say that's the direction we're going to go on, the first mover advantage, et cetera. But everything I'm seeing suggests that those first movers are actually fundamentally flawed in their construction.
Interesting. So, Michael, one last question, because John had asked this question and we have been making him wait for a while for him to get an answer on this. So quoting him, what are the real dangers of momentum investing, if any? Secondly, how much of an impact is it having on competitiveness and productivity of companies?
So the quick answer is the real risk associated with any investment strategy like momentum becoming dominant is that it creates the dynamics that allowed XIV, for example, to rise, and then collapse overnight, right? In effectively a single trade. The market signals under momentum become increasingly disassociated with the fundamentals. And the whole point of markets is, as much as we like to think that they're about making us money, they're really there to facilitate the allocation of capital. And so if we abrogate that responsibility and we hand it to a passive strategy that simply says, hey, whatever the last price was is the right price, and we're going to pile into this market with increasing size, you're going to get yourself pulled away. I like to describe it as you're driving a car uphill with no brakes, right? Doesn't matter until you crest the hill. The real risk emerges when that system becomes utterly dominated by those momentum strategies, because that then gives rise to systems that become so disassociated with the fundamentals that you encounter extraordinary crashes, i.e. a 1929 type scenario. And in today's world, where most credit is actually derived from collateral as compared to the ability to service it on an income basis, that can lead to wholesale disruption, because credit has a unique feature amongst the capital structure dynamics, and that it has change of control. If you fail to meet your credit obligations, you lose control of the asset. That causes restructuring of society in a very painful way. And that type of debt restructuring, that type of asset collapse, has broadly described the collapse of every democracy we've seen in history, going all the way back. As a republic, obviously, going all the way back to the Roman Republic, where the collapse of the Roman retirement system facilitated the rise of the empire, right? So there are very real societal implications associated with these things. Same thing happened in the Weimar with the loss of pensions, right? People basically at some point just start saying, would somebody just fix the system? I don't care if they take my democratic, my democracy away from me. I think that would be a terrible loss. And I'm hopeful that we're not inevitably pulled into that path, but it does feel that that's the direction it's going.
Interesting. Michael, there are a lot more questions that I have, but I think we wanted to keep it concise, talk about certain topics that are right now on top of mind for investors. We covered quite a bit, but just one final thing. Would like to know what are the interesting stuff that the team is doing right now within Simplify that investors should know about.
Well, so I'd mentioned the dynamic of, what we've done is we've created the ability to offer in a tax efficient manner strategies that historically were only available to accredited investors. And in particular, were designed for institutional investors who have tax advantage treatment. We're offering that in an ETF framework that is both more liquid, requires less due diligence, is available at lower cost. And so a lot of these strategies that people are looking at in hedge funds, I would broadly argue is worth checking out what we're doing in the ETF space. We've got products that range from hedged S&P type exposure to hedged emerging market exposure to we've just introduced our first credit products. We've just introduced the first fully functioning negatively correlated CTA, commodity trading advisor fund, labeled under CTA. We're going to be introducing retirement products in the next couple of quarters. And so we're working very hard to try to bring some really unique strategies and approaches into the ETF space that make them much more attractive for a lot of high net worth individuals that would be looking to allocate, for example, to a cheap beta S&P product plus a risk overlay from a traditional long volatility manager, right? We can combine those two together into a strategy that we believe offers significant advantages for the end investor and can be done at much lower cost.
Excellent. Well, that's it for now, Michael. And for everyone else who is listening to the session, Michael and his team is very passionate about exactly what they're doing in Simplify. If you have any questions, then do reach out to them. It was great to host you today, Michael. And
thank you very much.
And for all the listeners, I look forward to conversing with all of you in Quidroom. Bye for now.